One word has dominated the economic and financial landscape in 2022.
Inflation.
Inflation.
In the battle to control inflation, central banks have a key weapon in their monetary arsenal.
Interest rate.
Raising interest rates.
Base interest rates have risen at regular intervals throughout 2022, which has been a new and potentially painful experience for many of us. Because for almost 15 years, all we've known is extremely low and in some cases even negative interest rates. It suddenly means our mortgages, credit cards, business loans, all types of borrowing is likely to become more expensive, causing significant economic pain at a time when the cost of living is already soaring. It's a double whammy. So how did we get here? And even more importantly, how high could interest rates go? Here at Capital.com, we make all kinds of explainers about the stock market and the world of finance, giving you the analysis and insight you need to make informed decisions. Now, after watching this film, you might want to check out our interactive map of interest rates across the world. Just click the link. Anyway, back to interest rates. To understand why they're rising, first we need to talk about inflation. We spoke to Ed Yardeni. He runs his own research firm and is kind of a go-to guy when it comes to interest rates.
A lot of people are wondering why inflation has been rising to such an extent over the past year. How did we get into this mess? And I think the answer is the pandemic.
There had been a drive since the 2008 financial crisis to stimulate economic growth through loose monetary policy and economic stimulus, also known as quantitative easing. Then came the pandemic and a need to ramp up financial support. Combine this with post-pandemic supply chain disruptions, a global energy crisis, and the tightest labor market in decades, and you get the perfect inflationary storm.
The combination of all that monetary and fiscal stimulus did something that the central banks weren't able to do for many years, which was to get inflation over 2%. And beware of what you wish for, because not only did they get over 2%, they got it basically close to 8 to 10%.
Which is why central banks started raising interest rates. The question is, when are they going to stop? Now, I need to be clear. We can't tell you exactly where rates will go. I can't predict the future. If I could, I wouldn't be sitting here speaking to you. I'd be a very rich man drinking strawberry woo-woos on a beach in St. Lucia. But what I can do is look at history, analyze some data, and speak to an expert in the field. So let's start with the last time global inflation was at a similar level to today, and look at how high interest rates were hiked to get it under control, the 1970s and early 80s. A decade-long period of huge economic and political instability, characterized by something called stagflation. The recipe for stagflation is 1 cup of stagnating economy, 2 cups of high inflation, and 1 cup of high unemployment. Mix it all together, and you've got yourself a stale, overcooked, and extremely hard to recover economic pie.
The way it was dealt with back then is the Federal Reserve let interest rates rise to levels that caused a recession, and the collapse in demand relative to supply created disinflationary, if not outright deflationary forces.
In the US, then chair of the Fed, Paul Volcker, ramped up the base interest rate to an unprecedented 20% in 1980. Central banks in several other major economies took a similar approach to the Fed, though their rates weren't quite as bold. Volcker's maverick approach intentionally pushed the US economy into a recession and brought inflation under control. If you'd like to learn more about that period of Fed history and all about Volckernomics, we've got an explainer on that too. So could we see Fed Chair Jerome Powell and his other central bank counterparts following the same aggressive Volcker-esque use of interest rates?
So we're basically on the same path. The question is whether the Fed can tighten to such an extent that it will cause a recession, or whether we'll be lucky and find that demand slows just enough relative to supply to bring inflation down.
Unfortunately, without a crystal ball, it's impossible to say for certain. But there are some things we do know that might give us indications of why rates are unlikely to go that high this time. Firstly, it's a very different political and economic landscape from the 70s to now. The Volcker Shock, 20% Fed rates, were only implemented after a decade-long struggle to reduce high inflation.
We cannot wish
our way out of inflation.
Today's battle against inflation is still very much in its infancy. Central bankers and politicians also don't like recessions, so they'll be wary of hiking rates too much and causing one.
I'm an optimist at heart, so I think it's conceivable that unlike the 70s, we'll see the economy slow without a hard landing, and nevertheless we'll see inflation coming down.
Not everyone agrees, though. Bloomberg just announced a 100% chance of a US recession by 2023, so the politicians may not get what they want. Secondly, the housing market, one of the most important markets hit when interest rates rise, is a very different beast to the 1970s and the early 80s. In a nutshell, housing prices today just aren't sustainable at the interest rate levels seen then. Let me explain, and bear with me here because I'm about to throw a lot of numbers at you. An average US house in 1981 was around $70,000. At the peak mortgage rate of 18.45% with a 20% deposit, that's a monthly payment of $864. And here's the key bit. That $864 amounted to roughly 55% of the average household income after tax. Now, let's input that with today's average house price of $440,000 at the current average US 30-year mortgage rate of 7.2%. With a 20% deposit, this would mean monthly payments of $2,389. That's around 50% of median household income after tax today. So, although rates are much lower now, it's almost at the same level of affordability as it was in 1981. The reason for this is wage increases haven't matched the rise of house prices, which have soared, particularly in the past few years. And that has meant the ratio of median household income to house prices is now much higher than 1981. The ratio is almost 8-to-1 in the US and 9-to-1 in the UK, compared to roughly half that in 1981. Not so fun bonus stat, the average age of homebuyers in the US is now 47, compared to 31 in 1981. So, are current mortgage rates already at the level to tip the inflation scales?
I would say that we're kind of there with 7, 8, 9% mortgage rates. For the mortgage market, we're there.
So, all these elements would suggest that it's unlikely interest rates might reach 1980s levels. But what do the main central banks, markets, and forecasters predict? Let's start with the Federal Reserve. It acts as a sort of world central bank, setting the pace for all the others. The Federal Open Market Committee's 12 members meet 8 times a year to discuss forward guidance of the Fed's monetary policy, which gives us a pretty good indication of their thinking. Every member gives a prediction. The latest median rate predictions are 4.4% by the end of 2022, and a peak of 4.6% in 2023 before falling again. Even the most hawkish Fed members don't see rates going above 5%. However, don't take the Fed's word as gospel. A year ago, the Fed thought interest rates would be at 0.3% by the end of 2022. Now, we're heading towards 4.5%. As we're filming this, the market has priced in a peak rate of 4.9% by March 2023.
Well, in terms of the Fed funds rate, I think it's conceivable we'll get up to 5%, 4.5% to 5%. I think the mortgage rate, I don't think it's peaking, but I think it's going to stay in the sort of 7 to 8% range.
In August, the Bank of England initially forecast a peak rate of 3% in Q3 2023. However, it's been a rough few months for the UK economy. It's got the highest inflation of any G7 country, one of the highest median household income to house price ratios, and a devaluing currency following a controversial government mini-budget. After a series of policy U-turns, including an almost complete reversal of the tax cuts, Bank of England intervention, and the subsequent collapse of the Truss government,
I am resigning as leader of the Conservative Party.
The market has now priced in a peak rate of 5.3% in August 2023. Though some argue if the new government produces a sound fiscal policy, this could take pressure off the Bank of England to hike as high as this. The ECB is still dealing with economic problems stemming from the 2008 financial crash. In particular, key southern member states are struggling with high levels of debt and stagnating economies. Given the fact the EU is made up of 27 separate economies, some rich, others low income, it's much harder for the ECB to hike as fast as the Fed without causing financial instability.
Now the ECB's use the word fragmentation basically to describe the problem they have, which is, we're not dealing with one economy, we're dealing with different economies, different amount of debt, different fiscal policies, different politics.
The ECB rate currently sits at 1.5%. Although the bank is reluctant to give forward guidance, the markets have priced in a peak rate of 3% in July 2023.
I think the ECB and the Bank of England maybe at most have about 200 basis points more that they can raise their lending, their short-term rates.
Lastly, Japan, an economic outlier with an interesting monetary policy. In recent years, they've actually been trying to create inflation in their stagnating deflationary economy by implementing and maintaining negative interest rates alongside massive quantitative easing.
Japan's demography is very geriatric, and as a result of that, consumption is not particularly strong. They've had to try to stimulate the economy with fiscal and monetary policies.
Japan's inflation rate, despite all this, is at a high of 3%, significantly lower than the rest of the world. But that amount of QE, combined with a stagnating economy, means it's the most debt-laden country on Earth, with their debt to GDP ratio at around 266%. This sheer quantity of debt, combined with stagnating growth, means significant interest rate rises could break its economy. The Bank of Japan has announced a commitment to keeping rates ultra low and is expected to maintain negative or extremely low rates throughout 2023. Okay, so we've established market expectations for these four major central banks' interest rate rises. But could they go higher than projected? Central banks have been clear that reducing inflation to target levels is their main concern. Therefore, stubborn inflation, or any sudden rise in inflation, could see interest rates go higher than current projections, even if it means a more painful recession. And in Europe's case, the war in Ukraine and the economic standoff with Russia means the continent could face even harsher energy price increases this winter. And higher energy prices are a main driver of inflation.
European countries generally have the terrible situation of you're just closer to that war and the energy consequences that's having in terms of an energy crisis.
That could cause contagion beyond Europe.
So things could certainly go wrong, which would lead to more inflation and force the Fed to go full Volcker.
Full Volcker, 20% interest rates. Can you imagine? The thing is though, no one really knows exactly how high rates could hike. Economies are unpredictable at best, as Jerome Powell has said himself.
And no one knows with any certainty where the economy will be a year or more from now.
But if inflation remains stubborn, labor markets remain tight, and geopolitical tensions in Europe continue to escalate, pushing energy prices higher, central banks could simply keep on hiking, regardless of the economic pain it causes for the likes of you and I. Thanks so much for watching. Let me know in the comments where you think interest rates might go. And of course, if you liked the video, drop us a like, hit that subscribe button, and make sure you hit that notification bell. And I'll see you next time.